The pullback I flagged in Sunday's video, it showed up right on schedule. Honestly, it wasn't much of a surprise given the reports circulating about the Strait of Hormuz potentially closing again. I hope that heads up saved a few of you from pulling the trigger too early on a purchase from Summit Metals. If you held off like I suggested, good, because we're still in a window where these metal prices are giving us a real opportunity, and I don't want anyone leaving money on the table. Here's the thing. I genuinely believe most traders and investors right now are completely misreading what's happening in this market, and it's not entirely their fault. The news cycle has been all over the place, flipping the narrative almost daily. But that confusion is exactly what's going to leave a lot of people caught off guard when the next leg up for gold and silver kicks in. Let me explain why. If you look at this chart on screen, you'll see something the mainstream financial media is almost completely ignoring. Despite the major pullback we've seen from January's high, silver is actually breaking out against the S&P 500. Now think about that for a second. Stocks are still printing all-time highs in dollar terms, but when you price the S&P 500 in silver, the story changes completely. Today, it only takes about 90 ounces of silver to buy the entire S&P 500. Compare that to an average of 150 ounces in 2025 and nearly 200 ounces in 2024. That shift is a massive signal. What it's telling us is that we are likely in the early stages of a rotation, money moving out of stocks and into hard assets like gold and silver. Most people don't realize this rotation has a historical precedent. We saw the exact same thing kick off back in 2002, and it launched a 9-year bull market for precious metals. What triggered it then? Real interest rates went negative for the first time in 22 years. And right now, we're flirting with that same scenario again. Official inflation creeping above the 1-year U.S. bond yield. As I broke down in Sunday's video, the conditions we're seeing today closely mirror the setup between 2009 and 2011, and if there's one thing precious metals absolutely thrive on, it's a negative real interest rate environment. But here's where it gets really interesting. This cycle could end up being significantly larger than what we saw in the early 2000s bull market, especially if my theory about critical minerals and the U.S. government rebuilding its silver stockpile turns out to be correct. And I'll get into that shortly. So, here's what we're covering today. First, we'll dig into what a stock-to-commodities rotation actually means for silver's price trajectory. Then, we'll revisit the concept of silver's price floor and talk about why silver is having such a hard time sustaining any move below $70 an ounce. And finally, we'll get into the best way to position yourself for the next leg up, breaking down the role of physical metals, ETFs, and mining stocks, and exactly how I personally think you should be playing each one. Real quick before we dive in, a huge thank you to investing.com for making this video possible. I'll keep this short because I know you're here for the content, not a sales pitch. But if you've been following these midweek videos, you already know how much I rely on this platform to monitor market conditions. It's genuinely like having a personal financial advisor available around the clock. Right now, Investing Pro is 70% off, plus an extra 10% when you use my link, but only for roughly the next 20 hours from when this video drops. So if you've been on the fence, now is the moment. Use tools like the Warren AI model to build smarter price projections, or the stock comparison tool to surface undervalued miners like Santa Cruz Silver Mining. Link is in the description and pinned comment. Serious investors, especially heading into the next major metals move, need this in their toolkit. All right, let's get into it. For anyone unfamiliar with what a market rotation actually is, it's essentially when capital that's been sitting in one asset class starts migrating into another. We've seen a textbook version of this play out in equities over the last decade, where capital piled into the Magnificent Seven stocks, pushing them from roughly 11% of the S&P 500 up to over 30% today. But rotations don't only happen within stocks. Following the 2008 financial crisis, we watched capital bleed out of stocks and bonds and flood into precious metals. During that stretch, gold more than doubled, and the percentage of total ETF money allocated to gold ETFs went from somewhere between 2 to 4%, all the way up to 7 or 8%. So for every $100 sitting in ETFs, the gold allocation jumped from about $2 to $4 to nearly $8. Today, despite everything that's happened with metals prices from 2024 through now, that number has barely moved, sitting around just $2 for every $100. Now, since gold and silver interest bottomed out between 2022 and 2023, we've started seeing a slow but meaningful uptick. Gold ETF exposure has climbed from around 1% back up to about 2% of total ETF market share. And that relatively small shift has already been enough to drive a significant breakout in metals prices relative to stocks. It's exactly why silver has climbed from the number 8 spot on the list of most investable global assets all the way to number 3 today. And it's why it now takes far less silver to purchase the S&P 500 than it did just a couple of years ago. But here's the critical part, and this is where the real opportunity lives. We are still incredibly early. Gold ETF allocations are still roughly 4 times lower than they were during the 2009 to 2011 window. And while 90 ounces of silver for the S&P 500 sounds like progress, compare it to 56 ounces in 2010 and just 36 ounces in 2011. Silver already made one significant move, something comparable to its climb from $5 to $15 between 2002 and 2007. But the data is telling us there's a lot more runway ahead.
Here's what the numbers actually suggest. If this rotation continues toward the 2011 ratio of 36 ounces of silver per S&P 500, and historically that's not even an extreme low, considering the index dropped below 30 ounces in 1932 and below 10 ounces in 1979, then even in a bearish scenario where the S&P 500 sells off back to its 2025 lows near 4,800, silver could still easily hit $134 an ounce. That's a new all-time high. And if the S&P 500 holds somewhere around current levels near 7,000, which I expect it will if the Federal Reserve steps in during the second half of this year, whether through rate cuts or continued balance sheet expansion, which it has now done for 8 consecutive weeks, then an inflationary rotation into precious metals could push silver all the way to $194 an ounce. That brings my projected range for silver's next major move between $150 and $200 an ounce. I've been saying this since September of last year. This is not wishful thinking. The historical data and market structure fully support it. And I want to say something directly to anyone out there whose retirement is sitting entirely in S&P 500 index funds inside a 401k. You need to take this rotation seriously. Between 2000 and 2012, stocks went essentially nowhere, while precious metals delivered massive gains, all while the financial system itself was being questioned. If we get a repeat, And I think the conditions are aligning for exactly that. Stocks-only portfolios are going to underperform significantly. The time to diversify, especially into physical metals, is before that rotation becomes obvious to everyone. Now, with all that said, I want to be clear. None of this means we can't see one more dip before the next major move up. My base case still has a real recovery for silver materializing around September or October of this year, at which point I think we start challenging the all-time high. My price floor remains in the $60 to $71 range. That said, don't sit on the sidelines waiting for the perfect entry. Stay on a buying schedule. Here's why. The Investing Pro technical analysis tool, which I use regularly to cross-check my own analysis, absolutely nailed the last pullback in silver. Back on February 19th, it flagged a high probability of a pullback to $70 and then $64 an ounce. Right now, that same tool is far more neutral than bearish on silver. It's actually showing early signs that the bulls are beginning to gain strength. While it still highlights pullback buy levels at $68 and $61, it's also warning about fake breakdowns below $72, which is exactly my read on the situation, too. This is precisely why I rely on it and why I keep telling you to take advantage of that discount. Now, let's talk about what the options market is telling us. When I look at the current put-to-call ratio on the SLV Silver ETF, which measures bearish bets against silver versus bullish bets in silver, something interesting is happening. Back on March 19th, that ratio sat at 0.84, meaning nearly as many people were betting against silver as were betting for it. Today, that ratio has dropped to 0.53. Translation, for every single bet against silver right now, there are roughly 2 bets in silver's favor. That's not a definitive bottom signal by any means, but it's the kind of shift that typically shows up when patient buyers start re-entering the market as sellers begin running out of fuel. And it's been a consistent pattern around the $70 level specifically. Which brings me to something I think is being massively underappreciated. Silver's resilience around $70 an ounce is not a coincidence. This aligns almost perfectly with November's announcement that silver was being added to the United States critical minerals list. Silver crossed $70 for the first time in December, the very next month after that announcement, and since then has only closed below $70 for 4 trading days out of 80. That's just 5% of the time. Something is holding this floor, and as I laid out in Sunday's video, I believe that something is the United States actively rebuilding its strategic silver stockpile, which was completely liquidated 26 years ago. In my last video, I talked about Hecla Mining reporting silver realizations of $70 per ounce during the final quarter of 2025, even though the average spot price was only $55 during that period. I also walked through how that lined up with Critical Minerals Subcommittee member Debbie Wasserman-Schultz purchasing Hecla stock roughly 9 months earlier, as well as the Pentagon's partnership with Korea Zinc and J.P. Morgan to build a new smelter in Tennessee that will be used, among other things, to process silver. These are breadcrumbs, no smoking gun, but they all point in the same direction. The United States appears to already be executing what I've been calling Project Vault, a government-backed initiative to stockpile critical minerals, reduce dependence on China's dominance over those supply chains, and guarantee availability for American defense contractors. This program covers 60 minerals, including silver, and it functions as a soft price floor. When spot prices dip, Vaultco, the entity running the stockpile, steps in as a buyer at pre-negotiated prices currently being locked in with miners around the world. I believe that negotiated floor is somewhere around $70 an ounce, and that would explain exactly why silver has held this level with such stubbornness, even in the face of plenty of macro reasons to sell off back to $50.
Now, I want to address something head-on. I've heard some of you conclude that silver's upside is capped at $70. That is the wrong takeaway. Here's the thing. This is a global competition for a finite resource. Silver imports into China hit an all-time high in March 2026, running at roughly 10 times the seasonal average. And silver is fetching a premium in China versus Western spot prices right now. That kind of demand pressure has the potential to create a supply squeeze that would make 2011 look mild, especially once the $12 billion allocated to Project Vault starts running thin, and those price floors have to be revised upward to reflect real-world supply and demand dynamics, which, as most of you already know, is more demand than new supply can cover. Even factoring in the 3% decline in industrial silver demand from the solar sector, which a lot of people are overhyping as some kind of fix, it doesn't solve the structural deficit. It just makes it slightly less severe. And with NATO and the US signaling increased defense spending over the coming years, that industrial demand drop could be more than offset within 2 to 3 years. All right, let's move into the viewer question portion because I want to talk about how to actually position yourself for what's coming. There are 3 main vehicles people are using to get exposure: physical metals, ETFs, and mining stocks. Let me break down how I think about each one. Physical metals should make up the majority of your allocation here, full stop. It lives outside the financial system. There's no counterparty risk, and it will perform well through this cycle despite the slightly higher premiums you pay versus buying an ETF or a stock. Physical is the foundation. ETFs, in my view, are best used as trading vehicles. If you spot an opportunity using buy and sell signals, you can enter an ETF at near zero premium, capture the move, and exit. That's a perfectly valid approach. I'm also understanding of people who hold ETFs inside retirement accounts where physical isn't an option. That's fine, and it does give you meaningful exposure. But do not make the mistake of thinking an ETF is the same thing as owning physical silver. It is not. ETFs carry counterparty risk, and unless you hold a substantial position, over 10,000 ounces worth of PSLV for silver, or 400 ounces worth of PHYS for gold, you don't have an actual claim to the underlying metal. Mining stocks are where things get interesting for people who want amplified exposure to silver's upside without paying physical premiums. I'd keep miners to no more than 30% of your total precious metals allocation. This is a speculative sector, and it should be treated as such, but the leverage is real. Quality silver miners tend to move 1.5 to 2 times faster than the metal itself, in both directions. So if silver rises 10%, a solid silver miner might gain 15 to 20%. The flip side applies too. Now, here's something that stood out to me over the past 5 years. Silver is up roughly 180%, while the SIL Silver Miner ETF has only gained about 93% over the same period. That's a significant gap. And from a speculative standpoint, it tells me miners still have meaningful catching up to do relative to the physical metal. For patient investors with a bullish view on precious metals, this is a compelling setup. A while back, I asked you all to submit mining company names you'd like me to evaluate on the channel.
I got a ton of responses, and I promised I'd pick the 3 most requested silver miners. Given the silver focus of today's video, here's what I looked at: Santa Cruz Silver Mining, Silver Corp, and Pan American Silver. What I can tell you after pulling these up on the Investing Pro dashboard is that all 3 are showing projected upside following this recent pullback. Santa Cruz leads the pack both by analyst price targets and by the Investing Pro AI analysis. Importantly, all 3 are active silver producers, not exploration stage companies selling you a dream. All 3 carry a strong overall health rating, and 2 of them, Silvercorp and Pan American, pay a dividend. These are solid, credible companies, and I'll say this with confidence: these are 3 names I personally hold. I know them well, and I know Investing Pro assesses them accurately. Now, when I think about structuring a mining portfolio, my approach leans towards anchoring with larger, proven names, companies like Newmont or Pan American Silver, while keeping positions in smaller cap names, proportionally smaller. That said, having a diversified mix of small and mid-cap miners gives your portfolio real room to accelerate once metals recover and start challenging their all-time highs again. To find hidden opportunities with serious upside, like Santa Cruz Silver Mining, I use the Stock Comparison tool inside Investing Pro. It pulls up companies from the same sector and puts them side by side so you can spot what you might have missed. And I want to share 3 names with you right now that I think represent excellent opportunities for someone building a mining portfolio today: Fortuna Mining, Discovery Silver, and Iris Mining. Do your own due diligence on these, but from where I sit, all 3 have substantial upside in the next leg of this bull market, and they're a great example of how useful Investing Pro can be for identifying opportunities and analyzing them properly. One more thing before I wrap up. Remember the old Wall Street saying, "Sell in May and go away." If adding to your miner's position has been your plan, start building that position now, but spread it out over the next 2 months and use pullbacks as your entry points. We could easily see some seasonal softness over the next 6 to 7 weeks, and I want you taking advantage of that, not panicking through it. All right, that's a wrap on today's video. I did want to get into copper a bit more this week, but ran out of time, so that's moving to next week's agenda. Before I go, Investing Pro is available right now at 55% off, plus an additional 15% off using my link, but only for the next 20 hours from this video's premiere. I think I've shown you today exactly how much value this tool brings. If you can make it work financially, go for it. A genuine thank you to Investing Pro for making this video possible. And if you want to see more midweek content like this, clicking the link, even if you don't subscribe, actually signals to them that there's demand for this kind of content, so that alone helps. Take care of yourselves out there, take care of each other, and I'll see you all on Sunday. Goodbye.